There is a moment in every financial cycle when the biggest opportunity is hidden in plain sight, not because the evidence is missing, but because the majority of investors refuse to believe the implications of what they are already seeing. That moment may be unfolding right now in the gold and silver markets. While headlines remain focused on quarterly earnings, artificial intelligence, and daily stock market volatility, a much larger story is quietly developing beneath the surface of the global financial system. It is a story about sovereign debt, persistent inflation, shifting central bank behavior, changing reserve management, geopolitical fragmentation, and the growing realization that the monetary framework investors relied upon for decades is entering a new phase. Gold is no longer behaving like a forgotten commodity, sitting quietly in the corner of financial markets. It is increasingly being treated as a strategic monetary asset once again, while silver occupies an even more fascinating position, standing at the intersection of monetary protection and industrial necessity. Understanding why these two metals are attracting renewed attention requires looking far beyond their daily price charts and examining the structural changes taking place across the global economy. Throughout modern financial history, major bull markets in precious metals have rarely been driven by a single event. Instead, they have emerged from multiple forces gradually reinforcing one another until investor psychology changes almost overnight. During the inflationary decade of the 1970s, rapidly rising consumer prices, geopolitical instability, negative real interest rates, and declining confidence in fiat currencies combined to create one of the strongest precious metals rallies ever recorded. The environment today is different in many ways, yet several familiar ingredients are once again appearing simultaneously. Government debt levels across many advanced economies have climbed to historic highs. Fiscal deficits remain substantial even during periods of economic expansion. Central banks continue walking a narrow path between controlling inflation and avoiding unnecessary economic weakness. Every policy decision now carries consequences, not only for growth, but also for bond markets, currency stability, and investor confidence. Gold often responds not simply to inflation itself, but to uncertainty surrounding future monetary policy. When investors become unsure whether central banks can maintain price stability without creating financial stress elsewhere, demand for alternative stores of value frequently increases. This helps explain why gold has remained resilient despite periods of elevated interest rates that historically would have pressured non-yielding assets. One of the most important developments over the past several years has not come from retail investors or speculative traders, but from central banks themselves. Official sector gold purchases have reached some of the strongest levels seen in decades. Countries across Asia, Eastern Europe, and the Middle East have steadily diversified portions of their foreign exchange reserves. Although each nation has its own strategic reasons, the broader trend reflects an effort to reduce concentration risk while strengthening reserve portfolios with assets that carry no counterparty liability. Gold does not depend on another government's promise to repay debt. It cannot be created electronically. It carries thousands of years of monetary history behind it. These characteristics explain why central banks continue accumulating physical bullion even as financial markets become increasingly digitized. Such purchases do not necessarily signal an imminent collapse of the international monetary system, but they do indicate that policymakers themselves recognize the value of diversification during periods of heightened geopolitical uncertainty. Meanwhile, the US dollar remains the world's dominant reserve currency, supported by deep capital markets, legal protections, and unmatched liquidity. Yet reserve diversification can occur even without replacing the dollar. Global finance is capable of becoming more multipolar, while the dollar remains highly influential. Investors often misunderstand this distinction. The relevant question is not whether the dollar disappears, but whether incremental shifts in reserve allocation continue supporting long-term demand for gold. Another structural factor influencing precious metals involves real interest rates rather than nominal rates alone. Investors frequently hear about Federal Reserve policy decisions, but what matters even more for gold is the relationship between interest rates and inflation expectations. If inflation remains persistent while policy rates eventually decline, real yields could become less attractive, improving the relative appeal of precious metals. Conversely, if inflation falls decisively while rates remain elevated, gold may encounter periods of consolidation. This relationship explains why precious metals can sometimes rise during tightening cycles and occasionally weaken during easing cycles, depending on broader macroeconomic expectations. Financial markets are forward-looking mechanisms. They often begin pricing future policy shifts long before official announcements arrive. Bond markets deserve equal attention because they frequently reveal changing investor confidence before equity markets respond. Rising government borrowing requirements increase the supply of sovereign debt entering financial markets. At the same time, traditional buyers such as central banks and commercial banks may not absorb additional issuance at previous rates. If demand weakens, yields may rise unless monetary authorities intervene more aggressively. Higher yields increase borrowing costs across governments, corporations, and households. Yet excessive increases in yields can eventually slow economic activity enough to encourage policy adjustments. This delicate balancing act has become one of the defining characteristics of the current financial environment. Gold tends to benefit whenever investors perceive that policymakers face increasingly difficult trade-offs between maintaining financial stability and preserving purchasing power. Silver, however, introduces an entirely different dimension. Unlike gold, whose demand is dominated by investment, jewelry, and central bank purchases, silver occupies a unique dual role. It has served as money throughout much of recorded history, while simultaneously becoming indispensable to modern industry. Few materials combine exceptional electrical conductivity, thermal conductivity, and corrosion resistance as effectively as silver. As global electrification continues expanding through renewable energy infrastructure, advanced electronics, medical technologies, electric vehicles, and high-performance industrial applications, silver demand increasingly reflects technological progress alongside monetary considerations. Solar photovoltaic manufacturing alone consumes significant quantities of silver every year. Electric vehicles typically require substantially more silver than conventional automobiles because of expanded electrical systems and power management components. Data centers supporting artificial intelligence, cloud computing, and advanced telecommunications require sophisticated electrical infrastructure, where silver often plays a supporting role. Even if individual products use relatively small quantities, aggregate demand across rapidly growing industries becomes increasingly significant over time. Supply dynamics add another layer of complexity. Unlike some industrial metals that respond quickly to higher prices through expanded production, developing new silver mines often requires many years of exploration, permitting, financing, environmental review, and construction. Furthermore, much of global silver production occurs as a byproduct of mining for copper, lead, zinc, and gold, rather than from primary silver mines. This limits producers' ability to rapidly increase silver output based solely on higher prices. Recycling contributes meaningful supply, yet many industrial applications disperse silver in ways that make recovery economically challenging. As a result, sustained increases in industrial demand can tighten market conditions over extended periods. Nevertheless, investors should also appreciate that commodity markets rarely move in straight lines. Silver has historically exhibited greater volatility than gold, producing larger gains during powerful bull markets, but also experiencing sharper corrections when economic expectations weaken. Recession concerns can reduce industrial demand forecasts, temporarily offsetting monetary support. This dual nature makes silver both attractive and unpredictable. Investor positioning also plays a critical role. During periods of optimism surrounding economic growth, capital often flows toward equities, corporate credit, and higher-risk assets. During periods of uncertainty, defensive positioning becomes more attractive. Gold typically benefits first because of its monetary characteristics. Silver frequently follows once broader investor participation accelerates, although timing can vary considerably across market cycles. Another important consideration involves inflation itself. Many observers expected inflation to return quickly to pre-pandemic norms, following aggressive monetary tightening. Instead, inflation has proven more persistent across several economies, influenced by supply chain restructuring, labor market dynamics, fiscal spending, energy transitions, and geopolitical developments. Even if headline inflation moderates, structural inflationary pressures may remain above levels experienced during the decade following the global financial crisis. Such an environment encourages investors to diversify portfolios beyond traditional stocks and bonds. That does not mean abandoning conventional investments, but recognizing that different economic regimes reward different asset allocations. Currency movements provide another essential piece of the puzzle. Gold is generally priced in US dollars, meaning dollar strength can create temporary headwinds while dollar weakness often provides support. Yet the relationship is not always straightforward. During periods of severe financial stress, both gold and the dollar have occasionally strengthened simultaneously as investors sought liquidity and safety. Understanding these nuances prevents simplistic conclusions based solely on exchange rate movements. Geopolitics further complicates the outlook. Ongoing conflicts, trade disputes, sanctions, supply chain realignment, and strategic competition among major powers contribute to higher uncertainty premiums across financial markets. Businesses increasingly prioritize resilience alongside efficiency, sometimes accepting higher costs to reduce geopolitical exposure. These developments influence inflation expectations, commodity demand, and reserve management decisions, indirectly supporting interest in precious metals. Institutional investors are gradually reassessing portfolio construction after decades dominated by falling interest rates and globalization. Pension funds, endowments, sovereign wealth funds, and family offices increasingly evaluate alternative assets capable of providing diversification during periods when stocks and bonds become more positively correlated. Gold often enters these discussions because its long-term correlation profile differs from many traditional financial assets. Even relatively modest allocation increases by large institutional investors can meaningfully influence a comparatively small market. Yet optimism should always be balanced with realism. Precious metals face legitimate risks. Stronger than expected economic growth could support higher real interest rates. Sustained fiscal discipline could improve confidence in government finances. Technological innovation might reduce silver intensity in certain industrial applications over time. Central banks could maintain restrictive monetary policy longer than markets anticipate. Investor enthusiasm occasionally pushes prices ahead of underlying fundamentals, creating periods of volatility and consolidation. Successful long-term investing requires recognizing both opportunities and uncertainties, rather than assuming any single outcome is guaranteed. History repeatedly demonstrates that financial markets evolve through cycles rather than permanent trends. The strongest investment decisions often emerge not from predicting precise price targets, but from understanding probabilities and managing risk accordingly. For investors evaluating gold and silver today, the most valuable question may not be whether prices rise tomorrow, next month, or even next year. Instead, it may be whether the structural forces reshaping the global economy justify maintaining some exposure to assets that have preserved purchasing power across centuries of changing monetary systems. Gold remains a monetary anchor during periods of uncertainty. Silver combines that monetary heritage with expanding industrial relevance. Together, they represent two very different but potentially complementary responses to an increasingly complex economic landscape. Whether the next chapter becomes a powerful bull market, a prolonged consolidation, or something between those extremes will ultimately depend on inflation, central bank policy, fiscal decisions, technological demand, geopolitical developments, and investor psychology interacting in ways no single forecast can perfectly anticipate. What is certain is that the conversation surrounding precious metals has shifted from the margins of finance toward the center of macroeconomic analysis, and that alone deserves careful attention from every serious investor. The biggest opportunities and the greatest risks often emerge not when everyone agrees, but when long-term structural changes begin challenging assumptions that have guided markets for an entire generation. Share your perspective in the comments below. Do you believe gold and silver are entering a new long-term cycle, or do you think current optimism has already gone too far? If you value in-depth macroeconomic analysis, subscribe and join our community for future market insights. This presentation is intended solely for educational and informational purposes and should not be considered financial, investment, tax, or legal advice. Always conduct your own research and consult a qualified financial professional before making any investment decisions.